Good afternoon, viewers. This is CPA Charles Kafel, and today we are resuming our series on financial reporting, and we have a very short standard that is in relation to the non-current assets we've been seeing. In the last two videos, we've been looking at the tangible assets, but now it's our turn to look at how the intangible assets are going to be treated as far as the standards are concerned. We said that these intangible assets are accounted for under IS 38, that is intangible assets. And basically, when you're talking about intangible assets, I told you when you're talking about the non-current assets, we make sure we first know what is the nature of the asset. If it is tangible or intangible, that is as far as the nature is concerned. So this one falls into that category of the nature, not the purpose. Because we said when you're looking at non-current assets, make sure you consider the nature and the purpose. But here we are talking about the nature. It's in that first category of the tangible and the intangible. So these are intangible assets. Basically, these are non-monetary assets. In other words, these are assets which doesn't have any physical form. You can't they can neither be nearly cash or converted to cash, and they can not be even you can't feel them when you can't feel their existence. That's basically what I can say in the layman's understanding. But the standard gives us a scope of what is supposed to be included in the non-tangible or the intangible assets. And basically, when you try to look at what are some of the examples that we may be giving as far as when someone says I'm talking about the intangible assets or non-tangible ones. One, we may be having goodwill. That's one of the tangible assets, the intangible assets, because goodwill, it's what the public sees, and it has a value that is attached on that. So if let's say you are selling off your company and someone says they want to settle, they want to buy you off, you find that when they are paying, they may value the assets you have in the organization, and they end up paying more than the value of the asset, meaning the excess will be the value for the goodwill. But that one, I'm not here to talk about only goodwill. I'm just giving you a clear, at least you get something. The other one we can talk about is a patent right. Patent right, copyright, and all that. Those are just the restrictions that someone can hold a certain brand for a certain period of time and is restricting others to engage in that very same business. So they are also beneficial to the company in the sense that you are out competing, because you remain there, you remain as a monopoly in the market. You know the advantages of being a monopoly in the market. So the other one, we can talk about these companies which are selling antiviruses. Antivirus is an intangible asset. The other one we can talk about, there are so many intangible assets in the music industry. The labels, the rights to a musician, there are so many things. Even in the football, because I will not talk about much about the music industry because I'm not familiar with it, but we can talk about the football. Even football has a certain component of intangible asset. We are not, when you're talking about football players, we are not accounting for physical human beings into our financials. But here we are talking about the right of the player that right over the player, it's like, we can take an example. You may find that a certain club is buying a certain player at a certain cost. Let's say 100 million. Let's say Pogba, because I hear they was bought for 100 million. But when that person comes, he signs a contract. That contract has a useful life, let's say 4 years, 10 years, depending on which agreement they made. So you find that the club which is buying that player, actually the club has a right to even refuse a player to go and play for these international games, because they have a right over that player over that period of time. They are supposed to be with the player as far as the contract is concerned. Meaning, when we are accounting in our books, we account for the right over the player, the right we have over the player. And that amount we have got, we make sure we amortize. This way, we are not depreciating, but here we are amortizing. We spread that contractual amount over the useful life, so that we can be able to get what we can be having for recording in our books, because we make all those recordings in the books for an annual, we make them annually, so we amortize them over the useful life. So when you're talking about these intangible assets, there are certain things you should also understand before even we proceed with the notes you are seeing, is that there are some intangible assets which are there, but they cannot be part of or they can't be accounted for under this standard. The standard has a scope of where it's supposed to end. We are saying when you're talking about the intangible asset, definition-wise, it is an unidentifiable non-monetary asset without a physical form. Actually, the three words which are more important, it is: 1, the asset must be unidentifiable. 2, it must be a non-monetary asset. 3, it shouldn't be having a physical form like these other buildings and all the other tangible assets. So when you're talking about the unidentifiable asset, we are talking about it in the sense that that asset can be sold separately, or it can be rented out separately, or it can function on its own. So if an asset cannot be separated from the other processes, then we can't, even if it is an intangible asset, we can't account for it under this standard. Secondly, it must be a non-monetary. It shouldn't be like a cash or a monetary asset or something nearly related to the monetary attachments. So when you're talking about these items being able to, you can be able to rent them out separately, or they are standalone, they can function on their own. Then we are talking about the items. I can give you an example. If, let's say, someone buys a computer, that computer cannot function without this operating system, the Windows and whatever. They can't function. So even if Windows, they are intangible assets, we can't treat them like, we can't bring them here and we try to account for them under this standard, because those Windows, they can't operate on them on their own. Even the computer can't function. The hardware components, they can't function without those operating systems, those Windows. So even if the Windows are intangible assets, we can't account for them under this standard. But we can account for these accounting packages, because for them, you can sell them on their own, like QuickBooks, Tally, because you're seeing Intuit is saying those QuickBooks very expensively. and people are buying because they can function on their own. When the thing is installed, it can function and helps you do everything. If these they are antiviruses, they can perform on their own. They don't need any supplement that you do what you do. As long as you are put where they are supposed, they can function on their own, which is not the same with Windows. So when you are talking about this standard, make sure at least you get the concept that even when the examiners are giving these questions, they base on those scenarios. They can bring something, but what you have to first know is that, is it identifiable? Is it a non-monetary asset? Does it have a physical form? Those are the first conditions before even you look at the recognition criteria. How are we going to be recognizing them in the books? But you first identify really to first confirm whether they are really intangible assets and they are accounted for under this standard. Because as we've seen, you may find that even these assets, there are other assets which are non-monetary, but they are not accounted within this standard. Like the shares, they are non-monetary assets, but they are accounted for under IFRS 9. That's financial instruments. Those are financial instruments. So you have to be careful when you're analyzing questions that are related to the intangible assets. It is a very short standard, but it's a bit complicated because most of the times they bring scenarios, they bring scenario questions, and you'll be able to interpret basing on what the standard says. We can try to look at, having understood the definition, what we are supposed to incorporate in, then we see how are we going to incorporate those intangible assets in our books. And we are saying, one, those assets, intangible assets are recognized when, one, the entity controls the asset. If the entity can be able to control the asset, or it has a legal right or a contractual right over that asset, then we say it can be recognized as an intangible asset. Secondly, we can talk about assets being identifiable. We said that one, assets can be sold or rented out separately, or they are standalone items. They can function on their own. Thirdly, the assets have a value that can be measured reliably, because basically these two answers, the assets has a value that can be measured reliably, and it's probable that future economic benefits from the asset will flow to the entity. Those basically two recognition criteria, they are everywhere so long as we are talking about assets. Those, especially non-current assets, most of the times they are there. You can determine the value of the asset. Then, if you are sure that they will bring economic benefits, we say the probable it's above 15%, 50%. The probability of the asset bringing the economic benefits to the entity. Then we look at, if you have recognized that yes, they are intangible assets, what values are we going to attach in the financials? These intangible assets, we can measure them at cost. That is initial measurement, when you have just acquired them. When you acquire assets, that value, purchase price, and other direct costs that are associated with the asset are supposed to be included in determination of the cost. That is the initial measurement. Initially, they are measured at cost. Then subsequently, that's at the reporting date, we have two methods. One is using the cost model, and the other one using the cost model, and the other one is the revaluation model. We said the valuation model is more or less of the estimated market price. So when you're talking about the cost model, we are saying the intangible assets are carried at cost less accumulated amortization. Here we are not talking about depreciation, but we are amortizing. And impairment losses. How do impairment come in? If someone may say, but how these intangible assets lose value? Yes, if let's say you see, let me talk about the football stuff. If you see now the way Pogba is playing, he was bought expensively, but if you compare how much Man United can get after selling Pogba, you find that it cannot realize what it put in there. They paid over 100 million, but I don't think now they can be able to get 100 million. That's a loss, because they bought the person expensively, but now when the person is not performing well to the expectations, even the other one, you can talk about even Lukaku at Chelsea. They bought them expensive. They bought that guy expensively, but right now he was even given on a free transfer. He was given to go back on transfer to Inter Milan. So basically, you look at the things that someone can lose value even though something is intangible. Yeah, you see the amount you have acquired, and you see what you can actually get from the market. So that's what we call impairment losses. We are going to look at what are some of the indicators in the next slide. Maybe just talking about briefly, but I never wanted to talk about much impairment losses, because impairment has a standard that regulates it. So we are going to look at that later, but we can proceed to the next one, which is the revaluation model, and we are saying assets are revalued. Assets are carried at revalued amount less any subsequent accumulated amortization and impairment losses. Those, as I have already explained, this revalued amount is when you do if let's say you can now try to revalue how much Pogba can be sold to any club, you find that the amount you are going to get after selling him, you find that it's not going to be the same, even though you had amortized him by getting the 100 million you had paid, and you divide the useful life over the contract, but you may find that it's not worth it what they purchased. That's basically what we can say about it. But more to talk about in this is that what we can only say is that there are certain items of intangible assets that cannot be amortized, or that like if you don't know the useful life of that asset, you can't really know how much to spread the cost, what will be the useful life, so that you can be able to spread the cost. But what you will only do, we test for impairment losses annually. That's basically what we can do. So we can go to the next slide, and we'll try to look at what are some of the things that may lead to someone to lose the value or to do the impairment. We have the indicators of impairment, but this one we shall talk about more of them when we go to the other side of impairment losses, when you are dealing with that standard. We have the external, and these are examinable, so that's why I was forced to put them here, but the time we reach the other side, because we've been talking about impairment. So these are some of the indicators. We have the external sources and the internal sources. We can start with the external sources. We are saying that a significant decline in the asset's market value, more than the expected by normal use or passage of time. If let's say you've been with an asset for which had a useful life of 10 years, but now you have removed for, let's say, for 2 years, and you bought that asset, let's say 20 million, but as per now, after 2 years time, you find that they are giving you only 15 million. More or less that you have amortized that asset over the 2 years, but you may find that you are not fetching exactly what you should have gotten from there. That's one of the indicator that the asset has actually lost its value, or there is an impairment. Secondly, a significant adverse change in the technology. Technology may also lead technology, economic and legal environment. It happens if you are seeing if it is more or less in terms of the technology. You may find that if you talk about these computers, we had the Pentiums, we had the i3, i-core 3, i5. Now we are on i7, and others are using different. So that advancement in the technology, or the changes that occur in the technology, may lead to an asset to lose value, because if you are to sell a Pentium or i-core 3 laptop today, you can't fetch the same amount that you would have gotten in that period when they were still using those i-core 3. So basically that's what we are talking about. That's one of the indicators that at least the asset has lost value, even if it is still functioning the way it was functioning, even if it is still new. But so long as the software or the system is still on the other old version, people will try to lower the value of the asset. Then we can talk about the internal sources. We have the physical damage or obsolescence. You may find that the asset, it has been there, and the asset, it cannot even function to the expectations. And if you say, what, even if you bought it expensively, but this one can no longer support what we want, but let's reduce its value and we sell it off. The other one, we can talk about the significant change, and this happens in periods or expected in the way that the asset is being used. Assets become idle. Of course, when time goes on, you find that the assets you've been using, you are no longer using them. You just leave them there and you acquire more. If let's say you have an i3 laptop now, and yes, because of the work you were doing, you are unable to use that i3 and you've put it somewhere, you are now using i5 or i7, you may find that the other one, you will be forced to reduce the price and sell it off. Then we have evidence that the asset's economic performance will be worse than expected. If at all you don't expect the item to function well, then you rather sell it even if they give you cheap, but at least you dispose it off. Then loss of key employees. You may be having the let's say certain machines, and those machines you can't get people to operate them, or they are very sophisticated to the extent that even hiring those experts, it is too expensive. You rather sell it even if they give you less, but at least you go away with it, because at the end of the day you are not going to use it. You lack the experts. So those are some of the things we can look at, and we say that at least the asset is going to be impaired. So this is what we were talking about. We said assets with unlimited useful life. Of course, if something you don't know, like the reason why we don't depreciate land is because we don't have, we can't estimate the useful life of land. So there are also other intangible assets where you can't even know the useful life. Leave alone these other ways, the way, because there are other computations how we do goodwill. But if the company has been in operation, if let's say you talk about Coca-Cola, you don't know how the name of the Coca-Cola can disappear. Leave alone the way that we have other ways of computing goodwills and all that. But if you look at it on using a layman's eye, you might find that it is very hard for sure to trace that the brand for Coca-Cola is going to disappear, or Pepsi, depending on what is prevailing in the market, because people are consuming. Then the last bit we can talk about as far as this standard is concerned is the research and development costs. We are saying that these research costs, you know, when you are doing research, it is just a way of improving things, the way you've been doing things. You find new ways of doing things. If, let's say, you've been using labor-intensive technology and you are now going to the modernized way, the capital-intensive, you find that you have to incur certain cost of how are we going to advance from what we have been doing, and to find out whether that thing is going to be productive. So this standard permits that these research costs at whatever level, they should always be expensed. The reason why they are saying that these research costs should be expensed but not capitalized, even if the project you are working on becomes a success in the future, it's because these costs, they are like sunk costs. We already incurred them. They are already historical. We incurred them, and by the time we incurred those costs, we never knew that even this project is going to become a very successful one. So by all means, even if they treat they make the question look like anyhow that that we incurred these research costs, but at the end of the day, the project became a success, don't be tempted to capitalize those costs. They are supposed to be expensed. The reason is very simple, is that those costs we incurred them not knowing that the project is going to be a successful one. So they are supposed to be expensed, because even if the project doesn't become successful, you had already incurred the costs. They are more or less like we have wasted. If, let's say, you look at these people who start up the companies, the one we call the promoters, they start those companies, but the costs they incurred before the registration of the company cannot pay those costs, because you can't be contracting for a company which is not even existing. That's the implication. That if, let's say, you incurred when you are forming up the company, and you want those costs which you incurred before even the existence of the company to be paid by the company, it's really not being serious, because you incurred those costs without even the company being incorporated already. So that's basically what we can give, what I can highlight as far as IS 38 is concerned, intangible assets. If you want, you can look at there is a question that is August 2019. It was most actually all about a football player. They were giving you to players, and for them what they wanted is how you are going to account for the right over the player. As I said, we don't account for the player or for the human beings within the standard, but we account the right over the person, if it is a right over the musician and all that. Anyway, I urge you guys to subscribe for the channel so that we'll be able to learn more and more, because more things are coming and we are going to be doing numbers on each topic I finish. I want to be doing at least some good numbers on it. After understanding the concept, then we'll be able to catch up. Thank you.